What's up? My name is Lamb. This is Lamb Nation back at it again with another great video. So on today's video, I just wanted to start you off with some investment basics. So I just found a random website online, nerdwallet.com. Um, I don't think it really matters how you get your information as long as you get it. You can go out and spend a whole bunch of money on books and seminars and online e-courses and all of that stuff. But at the end of the day, as long as you're getting some kind of information, I mean, it helps. So you can't believe everything you see on the internet. So I would cross reference this stuff with multiple other websites and just YouTube videos and people and stuff like that, and just figure out what you can, or books from the local library, as many cheap and free sources as possible. There's plenty of information out here, and you can see that most of this information is standard. So what is the average stock market return? The average stock market is historically 10% annually before inflation. Stock market returns vary greatly, however. So I just did a previous video. I said 12% annually. They're saying 10%. You adjust for inflation, maybe that's after inflation, that's 7% or 8%, right? The average stock market return is about 10% per year for nearly the last century. So for the past 100 years, the stock market has returned 10%. The S&P 500 is often considered a benchmark measure for annual stock market returns, though 10% is the average stock market return. Returns in any year are far from average. So that just basically means that you're not going to get 10% every year. Some years you're going to get 20%, some years you're going to get 2%, or might be in the negative from year to year. Here's what new investors starting today should know about stock market returns. This is us. The historical average stock market return is 10%. The S&P 500 comprises about 500 of America's largest publicly traded companies and is considered a benchmark measure for annual returns. When investors say the market, they mean the S&P 500. So this is basically how, if you have a piece of the top 500 countries in the US right now and you own a part of each of these 500 companies. So what they do is what your investments would do, the top 500 companies. Keep in mind the market's long-term average of 10% is only the headline rate. The rate is reduced by inflation. Currently, investors can expect to lose purchasing power of 2 to 3% each year due to inflation. Learn more about purchasing power. That basically means that although you may have, whatever dollar amount you say it is, it's not worth as much because of inflation and prices being higher. So right now we say 2 to 3%. Could be 10%, 20%, 50% in the future, but we just go with what information we have right now. The stock market is geared towards long-term investments, money you don't need for at least 5 years. Yes, if you put any money in the market, expect to leave it in there at least 5 years to accumulate some kind of wealth, or maybe you put it in and the next day it goes down 20% and it takes 5 years to break even. You never know what can happen. For shorter time frames, you'll want to stick to lower risk options like an online savings account, and you'd expect to earn a lower return in exchange for that safety. Here's our list of the best high yield online savings accounts. This graph shows the current value of the S&P 500 as well as its year-to-date 5-year and 10-year returns between 1990 and today. You can see that there have been up years and down years, but over the 30-year period, those fluctuations have averaged out as a positive return. Year-to-date return, so I'm guessing just for this year-to-date, 14%. 10-year return, if you invested 10 years ago today, you would be up 11.4%. If you invested 5 years ago today, you would be up 12.4%. And like, you can basically see that if you started in 1990, it was 330, and then you waited about 10 years, you'd be up to almost $1,500. So your money would have grown in value, right, from here to here. And if you started in 1991 and took it out, or if you started in 1995 to 2000, either way you would have made money. Now this is the thing: if you were to invest in 1999 and then you waited and then your money goes down, you're like, oh, this sucks, the stock market sucks, people lie to me and they don't know what they're talking about. I'm just losing money. I don't know what I'm doing. So from 1999, then you let it sit there until 2002, and you're like, oh man, I'm gonna pull out all my money. And then look, in 2002, look what happened. It started to go back up, right? So that's why we say over the long term. So from 1990 to 2004 would be 5 years, which is what they say. But you might have to put it in higher, longer than 5 years. If you look at the peak of the market in 1999, then the bubble collapsed, and that didn't break even. The value was 1469, and this didn't break even until 1418. It didn't break even until 2006. So that was 7 years later. So you didn't make money until year 8. So you barely broke even at year 8, you know. But then look what happened at year 8. We had another crash from 2007 2008. We had another decline, right? And then you're like, oh man, this sucks. This is the second time it happened to me. I barely made any money the first time, then it went down again. But if you would have kept it in from our starting period in 1999 to what it is now at 2020, which is the previous trading day, this is December 26, 2020, it is $3,690 versus what it was in 1999 at $1,469. So it has what more than double in the past 21 years or 20 years. You see? That's why these are long-term plays, long-term investing. That's why you want to make sure that you are debt-free. That's why you do want to make sure you have your emergency fund, so that way you can ride these ups and downs, because you never know what the stock market is going to do or how long it's going to take for you to get these returns. So you do want to be in a good place financially before you even start investing. That's why I always preach that, and you want to have good mental habits and capacity for savings and not over consuming and stuff like that. Because if you expect a quick turnaround, you could, man. If you invested at the peak in 1999 and then you just breaking out even, you just getting back even at 2007, 8 years later, and then you like, oh man, it's up from here, and then it just dropped back down again. You in for the long ride at that point. You in there 9 years now, 9 years without no money. And then from the break even point where you actually started to, making money again, was from 1999 to 2012. That's 13 years, you know, 13 years. So what you going to do with your life in between 13 years while your money's growing? But then from 2012 on up, it's been a pretty good year, even with, you see the slight down from 2007 to 2008. So let's keep going. The average stock market return isn't always the average. While 10% might be the average, the returns in any given year are far from average. In fact, between 1926 and 2014, returns were in that average band of 8% to 12% only 6 times. The rest of the times they were much lower or usually much higher. Volatility is the state of play in the stock market, which just basically mean like, it goes up and down. But even when the market is volatile, returns tend to be positive in a given year. Of course, it doesn't rise every year, but over time, the market has gone up in about 70% of years, 70% out of 10. Versus if keep your money in your mattress, then you're losing money to inflation. I would at least gamble on, it's not even a gamble, but yeah, if you want to see it that way, it's a gamble. I'll at least a gamble on making some kind of money versus you're guaranteed to lose money from just leaving your money in a mattress or in a savings account. You're not making no money from that. You're losing it every day due to inflation. So at least this is something that can curb that inflation and give you some of your purchasing power back. So a lot of people say they don't want to invest because they're scared to lose money. You're losing money every day. Every day you don't invest, you're losing money to inflation. What to expect the stock market to return? There are no guarantees in the stock market, but this 10% average has been held remarkably steady for a long time. So like I said, I've been saying 12%. Maybe that was a little overzealous. Maybe 10%. We'll say 10%, 8% after inflation, 7% after inflation. So what kind of return can investors reasonably expect today from the market? The answer to that depends a lot on what happened in the recent past, but here's a simple rule of thumb: the higher the recent returns, the lower the future returns, and vice versa. Generally speaking, if you're estimating how much your stock market investment will return over time, we suggest using an average annual return of 6%. Okay, they say 6%. Either way, and understanding that you'll experience down years as well as up years, you can use NerdWallet's investment calculator. So, last video I used Dave Ramsey investment calculator, but NerdWallet has an investment calculator also to see what 6% growth looks like based on how much you're planning to invest. Like I said, if you want to hit that 1 million mark, 3 million mark, whatever your number is, go in there, put it in, however old you are, how much savings you have now. 6% growth is what they're recommending, and then just do it over how $100 a month, $600 a month, $1,000 a month, and just figure out how many years it's going to take at your number to get what number you need, and just play around with that and see what it takes to get there. That way you have a goal. That way you have something to aim for. You don't want to overinvest. Then you'll hate investing. You don't want to put in $1,000 a month when you only had to put in 600, and then you could have had $400 of discretionary funds. You don't want to underinvest, and you're out in la la land having a whole bunch of fun, wasting money, and you only putting in $100 when you needed to be putting in 600. So find that number, find out what works for you, and work backwards from there. And that's the best way to do it. So that way you don't have to hate investing or resent investing. This is for you. This is for your future. So here are 3 key takeaways if you're looking to make money in the stock market. Temper your enthusiasm during good times. Congratulations, you're making money. However, when starts are running high, remember that the future is likely to be less good than the past. It seems investors have to relearn this lesson during every bull market cycle. Yeah, don't get overzealous and think you have a whole bunch of money and then overspend, and then come next year, next month, it's a downturn, right? Become more optimistic when things look bad. A down market should cause you to celebrate. You can buy stocks at attractive valuation and anticipate higher future returns. So when things look bad, just remember, eventually they will go back up. How long that's going to take, we don't know, but it'll go back up. And just use that as a buying opportunity to buy into even more stocks. You get the average return only if you buy and hold. And this year, I wonder, they said 10%. I want to just buy and hold and then dividends reinvested, because that dividends reinvested might be the difference where the 10% and the 12% comes in. But because some people take the dividends and they live off of it, but you could do dividends reinvested. You get the average return only if you buy and hold. If you trade in and out of the market frequently, you can expect to earn less, sometimes much less. Commissions and taxes eat up your returns, while poorly timed trades erode your bankroll. Study after study shows that it's almost impossible for even the professionals to beat the market. Yeah, so don't try to time the market. Time in the market, that's the best rule of thumb. Over time, even a few percentage points can make the difference between retiring with a tidy nest egg and continuing to drudge away into golden years. I think they did some study into retirement and investing, and they said like 6% of trading days where the returns were really good make up most of the gains during investments. So just 6 days out of however many trading days it is. Let's see how many. Let's see. So how many stock market trading days in a year? 253. So out of the 253 trading days, they say most of your money will come out of 6 days. So the chances that you're gonna guess those 6 or 7 or 8 days right out of 253, I find that very unlikely. So don't try to time the market. Always remember time in the market. Ready to get started. If the market's long-term return sounds attractive to you, it's easy to start. You'll first need to open a brokerage account, which allows you to buy and sell stock market investments. If you're not sure where to open your account, see our list of best online brokers. So it's really not that hard. I encourage everybody to get to a point where they can do this. Like I said, you want to get out of debt. You do want to have your fully funded emergency account. 6 months, a year. With COVID, this should be a lesson to us all that that emergency money is needed. But eventually COVID will be over. The nightmare will be over. The recession, the hurricane, whatever, the death in the family, whatever you're going through will be over, and you will need money to live off of. So this is just something to keep in mind and think about in the future. And it's not that hard. They say the secrets of the rich. I mean, it might be some well-known secret out there, but if you are a honest person and you're trying to make honest living and not do anything shady or corrupt and political and all of that stuff. And if you just trying to be the average everyday person, even a business owner, an ethical business owner, I mean, how much can you do other than you know buy and sell products, offer a service, profit off of that, profit off of your employees, invest in the S&P 500, invest in real estate, and just work it over time. I mean, what else is there to do other than that? So everybody wants to get rich quick. It's way better to get rich slow. So thanks for watching.